You have $10,000 to invest in 2026. The problem is, you are trying to make decisions in a market saturated with noise. Every time you open an app, you're hit with the latest AI hype cycle, crypto FOMO, and social media claims of overnight success. When you're starting with a smaller portfolio, you face an intense psychological pressure to take massive speculative risks. A 10% annual return on $100,000 is significant, but a 10% return on $10,000 is just $1,000. This disparity often drives people to gamble their entire stake on a single volatile stock, just to make the potential gains feel worth the wait. You have two paths. You can follow the speculator's route, which involves active trading and high stress with a low probability of success, or you can take the owner's route, which relies on automated habits and high probability mathematical compounding. Warren Buffett has often considered how he would invest if he had to start over today with nothing but $10,000 and his accumulated knowledge. Instead of day trading, he would build a concentrated 4-position blueprint designed for long-term ownership. We are going to deconstruct exactly how this 4-asset allocation functions, the emotional discipline required to hold it, and why certain investors should avoid this strategy entirely. The ultimate choice isn't about picking a trending sector. Success depends on your willingness to trade the hope of rapid gains for the high probability of long-term growth. This chart shows the exact $10,000 allocation. 35% goes into an S&P 500 index fund, 25% into Berkshire Hathaway, 20% into Apple, and 20% into Coca-Cola. To succeed, you must view every share as a fractional ownership stake in a real business, with physical products and reliable cash flows. If you view these as mere numbers on a screen that fluctuate every quarter, you will likely sell them at the wrong time. This portfolio contains only 4 assets, because $10,000 is too small to diversify across dozens of stocks. Attempting to own 50 different companies with this amount would result in transaction costs and research requirements that erode your total returns. Early on, Buffett followed Ben Graham's strategy of buying cheap, struggling companies, trading below their liquidation value. This cigar butt approach involved squeezing one last puff of profit out of a dying business before discarding it. Charlie Munger convinced Buffett to change his approach. Munger proved that long-term wealth comes from owning a wonderful business with a durable competitive advantage at a fair price, rather than owning a mediocre business at a bargain price. This collection of assets is designed to survive economic shifts and compound value over several decades, rather than doubling your money in a single year. We begin with the foundation, $3,500 in an S&P 500 index fund. Even in a stock-picking strategy, dedicating 35% to a passive index provides a necessary baseline. This allocation gives you fractional exposure to the largest tech companies in the world, including Microsoft, Amazon, and Alphabet. A $10,000 portfolio cannot afford to balance meaningful individual positions in all these giants simultaneously, but the index does it automatically. This slice also serves a behavioral purpose. It requires zero research and captures the average market return, acting as a stabilizer that prevents you from making poor decisions with your entire stake. Next is $2,500 in Berkshire Hathaway. This is a diversified holding company that owns railroads, energy utilities, and massive insurance operations. Berkshire is built to endure market volatility. The company holds over $150 billion in cash and treasury bills, allowing it to acquire new businesses at steep discounts when the broader economy is struggling. For young investors, Berkshire provides a specific tax benefit. Because the company pays no dividends, all profits are reinvested internally by management, allowing your capital to compound without triggering an annual tax bill on your gains. Buying this collection of high-quality businesses at a reasonable multiple of their book value has historically allowed investors to outpace the market over decades. These first 2 positions set the stage. The S&P 500 captures broad economic growth, while Berkshire Hathaway provides a deep cash reserve and a collection of businesses that hold their value during recessions. The Apple allocation takes up 20%, or $2,000. This investment centers on the company's ability to integrate hardware and software so tightly that customers rarely switch to a competitor. Apple's competitive advantage lies in its high switching costs. When a user is committed to the App Store, iCloud storage, and multiple synced devices, The practical and psychological effort required to leave the ecosystem is much higher than the cost of a new phone. This loyalty allows Apple to generate nearly $100 billion in annual free cash flow. Management uses this liquidity to buy back shares and consistently increase the dividends paid to shareholders. The final $2,000 goes into Coca-Cola. Many modern investors are skeptical of putting 20% into a century-old beverage company, but Coke offers a specific type of stability. Coca-Cola is the ultimate affordable luxury. During an economic downturn, consumers stop buying new vehicles and houses, but they generally continue to spend a few dollars on a soft drink. This keeps demand remarkably stable across the entire economic cycle. The business model is remarkably efficient. Coke sells concentrate to independent bottlers who handle the capital-intensive work of manufacturing and distribution. This allows the parent company to maintain high profit margins with minimal physical overhead. This reliability allowed Coca-Cola to raise its dividend for 62 consecutive years, continuing the streak through every major war and financial crisis since the 1960s. Apple and Coke provide the reliable cash flow that funds the portfolio's expansion, while the broader market fluctuates. To maximize this $10,000, you must automate your dividend reinvestment. Setting up a DRIP ensures that every payout from these companies immediately buys fractional shares, increasing your ownership without any manual effort. The growth accelerates significantly if you add fresh capital. This chart shows that $10,000, combined with just $200 in monthly contributions at a 10% return, can grow to over $1.4 million in 40 years. This relies on dollar cost averaging. By investing on a fixed schedule, you remove the urge to time the market. When prices drop, your $200 contribution naturally buys a larger number of shares at lower prices. The only factor that can stop this mathematical progress is a decision to interrupt the compounding, selling during a dip, chasing a different stock, or withdrawing the principal early for consumption. The maintenance for this portfolio is minimal. Checking your accounts once a quarter to verify dividend reinvestment is sufficient. Watching daily financial news or checking prices constantly often leads to impulsive decisions that hurt your long-term returns. The math of compounding is highly reliable, but it requires the discipline to set up the system and then leave it entirely alone. You must accept that at some point the market will crash. Your $10,000 might temporarily drop to $7,000. This is a normal part of a full market cycle. During a crash, the underlying businesses remain intact. Apple still sells devices, and Coke still sells drinks. If you hold through the volatility, your reinvested dividends simply buy more shares of these companies at bargain valuations. The true challenge will come during the next speculative boom. When a new technology makes everyone else look like they are getting rich much faster than you, the pressure to abandon your strategy will be at its highest. Many intelligent people fail in the market because they lack the necessary temperament. If you cannot control the urge to buy during euphoria and sell during panic, your IQ won't protect your capital. Success with this blueprint depends on having the psychological resilience to stay calm while the rest of the market reacts to short-term noise. This flowchart helps you decide if this strategy fits your life. The core question is, when do you actually need to spend this $10,000? If your timeline is under 5 years, for example, if you're saving for a home down payment, this strategy is too risky. Stocks fluctuate wildly in the short term, and you don't want to be forced to sell your position during a market dip. For short-term needs, use high-yield savings accounts or bonds. If your timeline is 10 to 40 years, the outlook is much different. Historically, the S&P 500 has never generated a negative return over any rolling 20-year period. If you have a decade or more, this strategy is highly effective. This approach succeeds over decades, but creates significant risk for the impatient. Generating significant wealth from $10,000 depends on owning productive assets and minimizing fees, rather than timing markets or discovering hidden startups. Real wealth comes from owning quality businesses, keeping your costs low, and letting compound interest work over decades of quiet, disciplined patience.